Wall Street is more than just a street in New York City. It represents the heart of the American financial system. This iconic location houses major financial institutions, including stock exchanges, investment banks, and brokerage firms. But what does it mean for the average person? In essence, Wall Street is where securities, like stocks and bonds, are bought and sold. It operates through a complex network of exchanges, with the New York Stock Exchange, NYSE, and the Nasdaq being the two primary marketplaces. When companies want to raise capital, they can sell shares to the public, allowing everyday investors to buy a piece of the company. This process, called an initial public offering or IPO, is just the tip of the iceberg in understanding how Wall Street functions. It's a dynamic ecosystem where investors, traders, and institutions interact, driven by supply and demand. In a nutshell, Wall Street plays a crucial role in facilitating investment and growth, influencing not only the economy, but also the financial futures of countless individuals around the globe.
Who are the main players in this bustling financial hub? Wall Street is populated by a mix of institutional players, retail investors, and specialized firms. First, we have institutional investors like pension funds and mutual funds, which manage large pools of money and have significant influence over market trends. Next are hedge funds and private equity firms known for their aggressive strategies and high-risk investments. On the other hand, retail investors, the everyday people investing through online platforms, have become increasingly important, especially with the advent of trading apps that make investing accessible to all. Each of these players has unique goals and strategies, from long-term investing to speculative trading. Additionally, there are brokers and market makers who facilitate trades, ensuring liquidity in the market. Understanding these roles not only gives insight into how trades are executed, but also highlights the complexities of market behavior and the impact each player has on stock prices.
Now that you know the players, let's talk about how trades actually happen. When someone wants to buy or sell a stock, they place an order through their brokerage, which then routes that order to the relevant exchange. Trades are executed on the principles of supply and demand. When more people want to buy a stock than sell it, its price goes up, and vice versa. There are different types of orders: market orders, which execute immediately at current prices, and limit orders, which execute only at a specified price. Additionally, high-frequency trading has revolutionized how trades occur, using algorithms to make thousands of trades per second, often capitalizing on tiny price movements. This can lead to market volatility, as seen during significant events like the flash crash of 2010, where prices dropped dramatically in mere minutes. Understanding this trading infrastructure sheds light on the fast-paced environment of Wall Street and highlights the importance of strategic decision-making in investing.
Regulations play a crucial role in ensuring that Wall Street operates fairly and transparently. The Securities and Exchange Commission, or SEC, is the primary regulatory body overseeing the securities industry. Its mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation. Regulations cover everything from insider trading to market manipulation, aiming to create a level playing field for all investors. The Sarbanes-Oxley Act, implemented after the Enron scandal, increased transparency in public company accounting, ensuring that investors have reliable information. While regulations are vital, they can also impact how companies operate and how investors trade. Striking the right balance between oversight and market freedom is an ongoing challenge that shapes the landscape of finance. Understanding these regulations allows investors to navigate Wall Street more effectively and equips them with the tools to make informed decisions. Finally, let's explore how Wall Street affects your life, even if you're not an active investor. The financial health of Wall Street can have ripple effects across the economy. For instance, when stock prices rise, consumer confidence typically increases, leading to more spending and investment. Conversely, a market downturn can lead to job losses and reduced economic activity. Furthermore, Wall Street plays a pivotal role in retirement savings, as many pension plans and 401(k) accounts are heavily invested in the stock market. Therefore, understanding Wall Street isn't just for the finance savvy, it's essential for everyone. By grasping these concepts, you can better prepare for financial decisions, whether it's investing your savings or understanding economic news. In essence, Wall Street may seem distant, but its influence reaches every part of our financial lives.